Welcome back to the Explainer. Okay, so did you know that organizations globally lose an estimated 5% of their revenue to fraud, like every single year? It's a massive, staggering amount of money. So, if you're a focused learner looking to unpack the systems that actually make or break successful businesses and prevent those huge losses, you are in exactly the right place. Today, we are looking at a true paradigm shift, reimagining internal audit. Now, I know internal audit might sound a little dry on the surface, but I promise you, this is fundamentally a mystery-solving function. It's the mechanism that guards the vault of any major organization. Let's get right into it and see how this whole transformation is happening. Our source material gives us this really fascinating real-world anecdote to kick things off. Just imagine a mid-sized organization, right? The management team there had articulated these beautiful, incredibly comprehensive policies. They had implemented the proper hierarchical flow for all their approvals. Literally everything looked absolutely perfect on paper. And yet this organization just kept bleeding money, quarter after quarter. And we aren't talking about losing pennies here. They were hemorrhaging cash through duplicate payments to vendors and this incredibly inefficient inventory management that was just leaving stock rotting in warehouses. Crazy, right? So when the author of our source document dug deeper into this whole mystery, they found the true culprit. And here's the thing. It wasn't employee dishonesty, it wasn't lethargy or just a lack of effort from the staff. It was a gap. Specifically, it was the absence of an independent mechanism uniting policy with ongoing practices. Think of it kind of like a terrible game of telephone. The board makes this pristine company handbook, but by the time those instructions travel down through all the siloed departments to the actual operational floor, the reality looks completely different. That gap, that's exactly where the money was vanishing.
Section 1. Defining the modern audit. Beyond checking and compliance.
Okay, let's dive into this definition straight from the Institute of Internal Auditors. They define it as an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. Now, to really grasp this, we have to look at today's incredibly complex business environment. I mean, companies are dealing with intense regulatory pressures, super rapid digital transformations, and constantly rising stakeholder expectations. Because of all this, the audit function has been completely forced out of the back office. It's no longer just about checking boxes. And that term, objective assurance. Simply put, that just means providing an unbiased reality check to the CEO and the board of directors, basically proving that things are actually working the way leadership thinks they are.
That definition really splits the modern auditor's job into two vital dimensions. On one side, we have assurance. This focuses on evaluating controls, risk management, and governance. On the flip side, we have consulting, which involves directly advising management on process improvement. Now, you might be wondering, how on earth can someone be internal yet fully independent? It kind of sounds like a paradox, doesn't it? Well, the secret lies in their reporting structure. To maintain true objective independence, modern internal auditors typically bypass the CFO or operational managers entirely. Instead, they report directly to the board of directors or the audit committee. This is a real game changer because it allows them to maintain their autonomy while staying deeply, intimately familiar with the organization's daily internal operations.
And this brilliant quote hits the nail on the head. The goal is improvement, not punishment. There is this massive misconception out there that auditors are just fault finders looking to get employees in trouble. You know, they aren't the corporate fund police looking to confiscate your mechanical keyboard. Rather, they are trying to figure out why the procurement system accidentally ordered 500 keyboards instead of 5. The reality is that effective internal auditors spend their time asking why a process failed and how it can be strengthened. They are really acting as process engineers for your business, not police officers. Section 2, Internal versus External Audit, a clear comparison. Now, what's really interesting here is the massive contrast between these two roles. To grasp the true marketplace value of internal audit, we need to clear up some lingering confusion. An external auditor is primarily a financial detective. They usually come in annually to express a formal opinion on financial statements for shareholders and regulators, ensuring everything perfectly aligns with standards like IFRS or International Financial Reporting Standards. Basically, they are looking in the rearview mirror to verify the past. But internal audit? Completely different. Their scope is so much wider, taking in financial, operational, compliance, and even IT risks. Their work is continuous throughout the whole year, and crucially, their role is preventative and advisory. If external auditors look in the rearview mirror, internal auditors are looking through the windshield. They're there to stop the fire before it even starts, rather than just assessing the financial damage afterward. Section 3. The 3 core pillars. Creating strategic value.
So how exactly do they stop those fires? Well, there's a rule of three for value creation here. Modern internal auditing strengthens governance, manages risk proactively, and enhances internal controls. By focusing on these three pillars, the audit team acts as the critical eyes and ears of the board and audit committee. And it's super important to remember that these aren't just isolated random tasks. They work closely together to create this comprehensive safety net for the entire organization.
Let's start with governance. This pillar is all about accountability, transparency, and ethical behavior. The audit team assesses decision-making processes and evaluates compliance with established policies to avoid material losses. And, why does this matter? Well, because history is completely full of consequential corporate failures. Think back to massive scandals like Enron or WorldCom. Those catastrophic, literally overnight collapses happened because a severe lack of internal transparency and weak governance went completely unnoticed. It was exactly those massive failures that gave rise to modern regulations like the Sarbanes-Oxley Act, which made a formal, strong internal audit function an absolute necessity for reporting deviations to top management way before they can bring the company down. The second pillar is managing risk proactively. And this brilliantly illustrates the shift in focus. COSO's Enterprise Risk Management. COSO stands for the Committee of Sponsoring Organizations. And you can think of it as the gold standard blueprint that companies use to identify and manage risks. Auditors use structured frameworks just like this to evaluate mitigation strategies and really align the organization's risk appetite with its objectives. And let me tell you, modern risks go way, way beyond just finance. Today, internal audit is looking at severe operational distractions, like what happens if a key supplier just goes bankrupt out of nowhere, or cyber threats that could utterly spoil even the most profitable organization. The third pillar is enhancing internal controls, and this involves three very practical steps. First, testing controls under real conditions. Second, identifying the gaps between how a control was designed and how it was actually implemented. And third, recommending practical improvements. Let me give you a quick example. Imagine a company control that dictates any expense over $10,000 requires 2 managerial signatures. The auditor's job is to pull last month's records, test that control, and see if anyone actually got that second signature, or if the system just, waved the expense right through. This is exactly where internal auditing directly translates into massive financial savings and operational efficiency. Because at the end of the day, a control only matters if it actually works in practice. Section 4. Auditing in the digital age. Navigating new frontiers. Let's move on and see how this builds, because the digital transformation has completely changed the risk landscape for modern businesses. As companies adopt massive ERP systems, which is enterprise resource planning software, basically the central software nervous system of a company, think SAP or Oracle, and as they shift their data to cloud computing, risks are evolving at breakneck speed. Internal auditors are now heavily involved in assessing cybersecurity controls, data integrity, privacy, and system access. Reports from major firms like Deloitte emphasize that having a technology-savvy internal audit team is absolutely critical for digital resilience today. You simply cannot audit a modern tech stack against threats like cloud misconfigurations or devastating ransomware attacks without some serious, specialized digital knowledge. And because the risks have upgraded, the tools had to upgrade too, right? We're now looking at continuous auditing tools, exception-based testing, and predictive analytics. This data-driven approach is a total game changer. It allows audit teams to focus way less on manual randomized sampling and much more on generating really powerful, targeted insights. For instance, exception-based testing means that instead of manually checking, say, 50 random invoices out of a million, AI algorithms can instantly flag the one single invoice that was paid at 3 a.m. on a Sunday to an unverified offshore account. It spots those crazy anomalies the human eye would just never catch. Section 5. Overcoming practical challenges. The path forward. Now, despite its immense importance and all these powerful new tools, the audit function still faces very real hurdles in practice. These obstacles are super common, but they are formidable. We're talking about limited resources and massive skills gaps. Historically, auditors were mostly accountants, but today, they need to act like data scientists and cybersecurity experts too, making them absolute unicorn hires that are very, very hard to find. There's also often a lack of required independence if those reporting lines we talked about aren't structured correctly. And of course, there is resistance from operational staff who might still view auditors as a policing force, rather than a trusted advisor who's just there to help optimize processes and prevent fraud. So the crucial point is, how do we actually overcome this? The solution requires strong, unwavering support from senior management and the audit committee. In the business world, this is known as the tone at the top.
Navigating these challenges demands that leadership sets the right example alongside ongoing professional development for the auditors themselves. Think about it. If the CEO dismisses the auditors, the warehouse managers and IT directors are going to dismiss them too. Top-down support is what actually gives the internal audit function its teeth. And we land on this powerful concluding thought from our source material, because strong organizations are built on strong assurance. Internal auditing is no longer just some dry regulatory compliance requirement. It is an absolute strategic necessity for managing uncertainties, protecting your organization's value, and ensuring you actually hit your long-term goals. Which leaves us with this final, really important question for you to consider. Is your internal audit a checker or a value creator? I want you to reflect on your own organization's practices. Are they just ticking boxes, or are they proactively finding ways to save money, reduce risk, and create true value? Let us know your thoughts in the comments. Thanks so much for joining this explainer, and keep learning.